Prasanna Balachander, Head of Global Markets and Proprietary Trading Group at ICICI Bank, now joins in. Prasanna, thank you so much for taking our call. Firstly, your reaction to what we've heard over the weekend, the measures announced by the government, will it have any material impact on the current account deficit? How is the market digesting it?
So thanks for having me on the show. The first thing is that the very fact that the government is taking stock of the dollar-rupee currency volatility is itself by itself a signal and by itself is positive. And what the market was expecting, however, was more measures on the current account deficit side, because as you know, the current account deficit has actually swung from around $15 billion 3 years ago to in the region of likely to be in the region of around $80 billion this year. So what the market was expecting is more measures to be announced by way of encouraging exports and by way of discouraging non-essential imports. So to that extent, the statement of intent by the FM was very heartening to note that he has actually identified that as a very important problem. So yes, markets are very happy from that perspective. And will be looking forward for more action from the government on bringing down current account deficit. What measures actually came out on Friday where almost all of it was related to capital account flows. And I was hearing your commentary just before you took me on. So I too agree that capital flows are normally, you're supposed to be doing it when you're in a position of strength and not when you're in a position of weakness. So yes, over a medium term, maybe 3 to 6 months time, all these things will bear fruit in terms of incremental flows into the country. But nothing is going to come in today, tomorrow. So when they take measures as far as the CAD is concerned, that's when the market will take comfort from the kind of measures that government is likely to come out with.
Prasanna, afternoon, Ira joining in as well. So would you then also, believe that there could be a second round of measures? This may be enough to send some sort of message to the market. But should the currency continue to fall, would they move to the second line of defense, which could be in the nature of a swap window for oil companies or something?
So absolutely, Ira. So I actually think that this week is going to be heavy with a lot of regulatory policy-making related announcements. The fact that the FMS himself admitted to the fact that they are looking and consulting with other ministries as to what measures they want to come out with to constrain the non-essential imports. I do expect those announcements to come in this week. And I also feel that the oil, the separate oil window, a dollar window for oil companies was something that could have been announced on Friday itself. The major disappointment in the market today with respect to the dollar-rupee rate is primarily on account of the fact that a dollar window was expected and that didn't come through. Because what the beauty of that is, though I'm not a great fan from a fundamental perspective, it's not the best thing to do in normal situations. You are effectively taking the demand from the dollar oil companies for dollars out of the market into a separate, where the central bank comes and does it. So it's actually two things rolled into one, where the intervention also is happening at the same time when RBI is taking it off the market. So it's not a very fundamental thing to do, but actually if that was the right thing for us to do at this point of time, because the demand for dollars is something that is quite high, on the higher side, and this would have actually made the demand-supply balance a little bit more palatable for the markets.
Prasanna, what about the 10-year? Was there anything in the announcement made over the weekend by the government? Does it, from a signaling standpoint, mitigate the concerns in the bond markets?
So bond markets are hostile to both oil as well as how Dolex moves. So it's a fact of life that if oil continues to go up and if it crosses 80, for example, our yields will be much higher. And similarly, if dollar were to appreciate against the G3 and the G7 currencies, it's a no-brainer that EM currencies also will weaken, and if EM weakens, India will also weaken. So yes, you have a current account deficit problem, which is which is a problem of India's making, which India could solve it. But also there is a global contagion effect, if you want to call it that way, where all emerging market currencies are going down. So the bonds are going to be a complete reflection of how the global markets in both the Dolex as well as oil move. And then you also have the added disadvantage, so to speak, of U.S. interest rates also going up and U.S. dollar liquidity also coming down as U.S. central bank reverses the QE. So it's kind of from all sides you can say that there are concerns. So it's very difficult for us to stand out in isolation. And if global rates are on the way up because of QE reversal or because of US central bank hiking rates, then India will also have to, I guess, follow suit.
Prasanna, just last quick question. A lot of people are now coming around to the view of an October rate hike. Since we last discussed this, we've got another inflation print. Plus, of course, the Rupee story is played out. Are you convinced that we are going to go towards another rate hike in October?
Yeah, so our official call is of a 25 basis point rate hike in October. But however, I do feel that the probability of 50 basis point rate hike has definitely increased, primarily on account of the depreciation in the rupee that we have seen in the last, say, 1 month to 1.5 months post the earlier policy. And the reason I'm saying that is because some of this depreciation seems to be rupee specific and does not seem to be, a result of dollar's appreciation. So from that perspective, I would say that the odds of 50 basis point rate hike has definitely increased. And I think also from the perspective of financial stability, though I do agree from an inflation standpoint, it's difficult for you to, hike at this point of time when inflation has come lower. But then you can always make an argument that you make policy for expected inflation and not on current inflation. And from an expected inflation, you can make the call that oil price has also gone up as well as the rupee has depreciated substantially. And hence, the forward-looking view on inflation also goes up to some extent, to that extent. So I do think that RBI will be thinking in terms of a bigger rate hike. Definitely, they will be discussing it. And whether they actually come out with 25 or 50 is anybody's call. And it also does is if they do a bigger hike, say a 50 basis point, it gives comfort to the minds of the international investors that RBI is not behind the curve. You've seen many central banks actually hiking rates. You've seen Indonesia hiking 100 basis points in the last 4-5 months. You've seen Russia doing a surprise rate hike last week. You've seen Turkey and Indonesia, Turkey and Argentina doing big hikes. Of course, we don't need to be compared with those countries, but at least Indonesia is a peer country to that extent. So I think we should be looking at a 25 to 50 basis point rate hike.